is Dr. Richard Peterson speaking today on trading on sentiment. Thanks everyone for joining. And I'll start with a quick description of what this talk will be about, and then we'll dive in. Should be pretty interesting today, at least from my perspective, of course. So the work that I'll be talking about today is research on media analytics and how media analytics appears to both identify and then predict patterns in financial market prices. It's very broad scope. Today we've gone into much more detail in our recent book called Trading on Sentiment, but this talk will hit the highlights of that book, including strategies for identifying long-only equities, timing decisions, currency strategies that we've identified as well through media analytics, as well as shorter-term strategies that seem to take advantage of anomalies in the information flow. So, like I said, the information will be in much more detail in our new book, Trading on Sentiment, which I'll describe later. This image on the first slide is from May 6, 2010. For many of you who were in the markets back then, you'll recognize this as the day of the flash crash. May 6, 2010, also on the streets of Athens, looked a bit like a war zone. These are also some images from that day. There were financial news reporters on the streets of Athens then commenting on how it appeared the Eurozone was breaking apart, how this could be Europe's Lehman moment, but even bigger. And the tension in the air was, of course, palpable. We did media analytics on the news flow and social media flow that day. What we found in the references to companies was also quite interesting. Here's an example. This is a red line is a 60-minute moving average of expressions of fear around the top 500 companies in the U.S. stock market, in the S&P 500. And what we see here is in a rolling 60-minute average that midday there was a large spike in media-related fear. You can see that as this red line crosses the blue line. Now the blue line is the S&P 500 price on a minutely basis throughout that day. So we see a big surge in fear. Then we see the blue line starting to roll over, fear declines somewhat, and then spikes again. And in fact, the second spike was a reaction to the decline in the S&P 500. This event, the flash crash, took off $1 trillion in notional market value intraday, and it was an almost 10% decline intraday of the index value of the stock market. Of course, it was considered a very terrifying moment for many investors. Some stocks like Procter & Gamble went down to 1 cent per share. So some of the largest companies in the world were suddenly mispriced. This event was subsequently investigated by the CFTC and the SEC, and the subsequent report stated that there was a large sell order, E-mini sell order, that prompted this event. Now, the size of that sell order was a couple $2 billion. It was not that large given how many of those orders happen pretty much every day when people are repositioning in, say, a large mutual fund. The other thing that was interesting about this report was it was widely ridiculed that this could be the cause of the event, would be a large sell order, was thought not plausible. So the CFTC and SEC went back to work and didn't really find much else until last year. They found Navinder Sarao. So in 2015, they blamed Navinder Sarao as spoofing the markets, and he's been indicted for spoofing activities on this day. So on the day of the flash crash, Navinder Sarao, who was running small robots that were essentially putting on sell orders in order to drive the price lower so he could then buy at a discount and then sell higher, he made about $780,000 on the day of the flash crash, despite the fact that $1 trillion moved. And also despite the fact that he was continuing to spoof on other days subsequent to the flash crash and did not cause flash crashes. So looking at the primary cause of the flash crash, the large sell order, the spoofing activities don't seem to be potentially the real cause, maybe something else. In this case, what we're arguing is that the media tone, the change in the media tone may have affected trader behavior collectively. And that's really what this talk is about today, is that media tone can change trader behavior, which subsequently changes prices. There's literature in the behavioral economics that shows that when investors are primed to feel fear, for example, shown a short movie clip from a movie like Psycho or The Shining, that subsequently in an experimental market, they change how they set their bid and ask prices. They lower their ask prices and they lower their bid prices. And that's pretty much what we see here. In fact, what happened during the flash crash was the asking prices were lowered dramatically, and the bidding prices pretty much disappeared. Nobody wanted to buy. Everyone was doing a flight to safety, essentially, and others were trying to sell to get out. So what we're arguing here is that perhaps the media tone does subsequently affect prices. And this, by the way, is in the top decile of fear values for the year. It's not dramatically high. However, this is sentiment. This is a rolling average of overall sentiment, positive versus negative references to those companies in the S&P 500. And what we see here is that sentiment actually hit the lowest level of 2010 before the flash crash. So in fact, overall sentiment was extremely negative, the lowest for the year before the flash crash actually occurred. So this is somewhat telling that information flow may affect trader behavior, at least on this level of a single market event. The question, though, as quants is, can this be found to recur? Do patterns like this recur again and again and across markets? We have some evidence that, theoretically at least, that there could be some support for this argument. So we know that investors make systematic, predictable mistakes depending on the information they receive. We call this mind. So they're investor reactions of overreaction or underreaction to certain types of information again and again and again. We also hear this in the idea of biases like the framing effect or anchoring or the endowment effect, different cognitive biases that lead to behavior that's non-optimal. That is, behavior that doesn't take advantage of the value of repeating patterns. So individual investors will not perform the activity that would give them the highest expected value return sometimes, and based on some information. And this has won Daniel Kahneman a Nobel Prize in economics in 2002. Has also led to a Nobel Prize for Robert Shiller in 2014 in economics. This idea that not only individuals make collective mistakes, but in the case of Robert Shiller, that there are collective mistakes in markets. So markets have cycles. We know there's manias, trends, panics, and in the case of Robert Shiller, he identified bubbles in markets. So we have Daniel Kahneman looking at individual mistakes, Robert Shiller looking at market cycles. The question is, how do we unite these so that we can create predictive models of markets? So what we've done is now worked on media sentiment analytics. So it's looking at what are the topics and tones and macroeconomic themes that elicit collective reactions among traders that may then create patterns in prices. Because if this does in fact occur, then we can take advantage of this through modeling, through proper use of statistical analysis. So we'll start with a quick overview of what I mean by the mind distortions here. So in this simple investment experiment, subjects were asked would they like $10 or a choice. If they chose the coin flip, if it landed heads, they'd win $30. If it landed tails, they'd win 0. So the expected value was 15. And the question was, would people prefer safety and the guaranteed return, or would they take a financial risk of the coin flip? And about half of the people took the coin flip, and about half took the financial guarantee, the $10. But what was interesting here was when they were offered a face, to see a face and labeled as a man or a woman before they were given this choice, if the face had an emotional expression on it, it dramatically changed their risk-taking. So if there was a happy face on the picture versus an angry or fearful face, they were 30% more likely to take the coin flip. More importantly, they denied that the expression on that face had affected their judgment at all. It was completely unconscious. And when they were asked on a scale of 1 to 7 to rate how they felt, most of them, or the average rating was 4 in advance. And subsequent to the choice, it was also a 4. So these subjects rated themselves feeling on average about a 4. And after seeing the face, they also rated themselves feeling a 4. They did not think that the face had affected their judgment, yet there was this dramatic shift in their risk-taking, a 30% shift. This effect occurred unconsciously and is called emotional priming. Now, this affects markets in sometimes subtle ways and sometimes very obvious ways. It's probably what affected the financial markets on the day of the flash crash. People were probably emotionally primed by those violent and vivid images. This image that I have on the screen now is Hurricane Katrina, which was the largest natural disaster in U.S. history. This was a Category 5 hurricane, and it was followed a a month later by Hurricane Rita, another Category 5 hurricane that made landfall in the United States. There's significant damage from both of these storms, and then Al Gore's movie An Inconvenient Truth came out, which described how ongoing catastrophic storms were likely to increase in frequency due to global warming. Now, Wilbur Ross and Warren Buffett both went down to the U.S. Gulf Coast, bought reinsurance companies, and when the media asked Wilbur Ross why he was buying a reinsurance company when everybody knows that the rate of storms is likely to increase, he said, well, quote, "We go where the perceived risk exceeds the actual risk." And that's the key to understanding sentiment and data. Perceptions is what we're measuring. We measure the perceptions in the media. The actuarial models that he has, for example, of Category 5 hurricane risk showed perhaps an increase because of global warming, but nothing near the 50% rise in insurance premiums that occurred each of the next 2 years because of the perception, because of the fear that flooding would increase and then more of these storms would be coming. So that's the key, is identifying what do people perceive as being the risk and identifying if that is in fact an anomaly, if that deviates from the reality. So the level of markets, so we know now that the mind has these biases in how it makes decisions, so that perceptions can exceed or underperform reality. So how does this play out in markets? Well, there's some types of data that hit markets that is very rapid. It's immediately digested. Computers and robots take advantage of it quickly. This is the non-farm payrolls release. So of course in the beginning of the month, we, if you're attentive to financial news, you'll hear, okay, this Friday we're having the non-farm payrolls, the number moved the markets, X%. What this is the number of jobs that are reported in the U.S. economy being created in the past month. So typically the number lately might be between 200 and 300,000 a month. So this date, on December 5th, 2014, just after the number was released, it was slightly higher than expectations. And the robots of high-frequency traders immediately took advantage of this and transacted about $29 million within 100 milliseconds of the non-farm payrolls release. Now, this is the type of information that moves markets very quickly. It's known that is good. Computers know what to do with it. But there's obviously much more information that moves markets over different frequencies. Tones, like the amount of conflict in Greece, for example, or the devastation from a hurricane. Those things affect the markets over different periods of time, and that's what we're interested in today, is these systematic patterns. How they do so is through feedback loops. Essentially, news and information hits traders. It generates some kind of sentiment as they compare it to what they already expected in markets. So for example, if we are expecting a quiet day in the S&P 500 and the information flow becomes increasingly negative about Greece, our sentiment starts to turn negative and we become more and more risk averse. That might lead to selling behavior or an absence of buying behavior, but it can subtly, through emotional priming, change our behavior. Subsequently, we might become more attentive to what's happening in prices. We watch the price action, and that price action itself becomes new information. We watch the price action, we compare it to the media, and we think, wow, things are getting bad. This is pretty negative. Sentiment becomes more negative. Behavior might be more inclined to sell or less inclined to buy. And it creates a bit of a feedback loop, and then we watch as others are selling, prices are dropping, and the feedback loop continues until we might, watching minute by minute, ourselves panic out of the market. Then, of course, during the midst of the panic, we might watch, say, Jim Cramer on CNBC, who says, wow, this doesn't make any sense, it's time to buy. And think our rational brain will override that sentiment and think, yes, it is time to buy. And we'll interrupt the pattern, and then the markets will rebound. So there's this feedback loop that can be interrupted by logic, but typically it happens unconsciously and is very difficult to control until once it's obvious. Here's an example of, well, there's two types of feedback loops. Here's the overreaction one. I've been talking a lot about fear so far today. This is the S&P 500 in early spring of this year. So the beginning of the year in January, the markets dropped quite significantly, had essentially a correction, rebounded a bit, and then dropped again. Now in the second drop, this blue line represents the amount of fear about those companies. We see a big spike in fear right here at the bottom. This fear spike represents capitulation. News media, social media, all described how investors were panicking, investors were terrified. There were a lot of anxiety and worry out there. This didn't happen before, interestingly. That other fear, or that other decline happened for about a month. It didn't generate a fear spike, but the second one did. And this is the sign that risk aversion has really entered the market, and the bottom is likely in for the moment. So subsequently, the markets have rallied more or less since that date in February when we had the fear spike. That's called overreaction. Traders overreacted to worries about the Chinese economic slowdown and some other worries at that time. Now, the second pattern that we see here is underreaction. So this is from 2012 to 2015, a nice smooth trend in the S&P 500 as it rallied and rallied from 120 to up over $200 a share in the SPY, the ETF that's based on the S&P 500. And then we see a nice smooth sentiment curve that just generally increased gradually over those several years. What this means is that information was improving, and investors were sort of following it, buying along the way. But because this is a 500-day average, it's quite lagged. And so what was happening was information was improving, and people weren't really taking advantage of it. We've got some other charts I'll show you of this to show how it works. But ultimately, good news was coming in, and because it appears that because the financial crisis had been so negative, it was taking people a while to warm up to equities again, and thus providing an opportunity for those who could get over their qualms more quickly to jump in and take advantage of the rally. So now we'll talk a bit about media analysis. How do we do that? How do we actually create this type of sentiment so that we can analyze it and create models? And then subsequently in the talk, I'll talk about specific strategies that take advantage of these patterns, the underreaction and the overreaction types of patterns. So first of all, we have these 2,000 global news sources that we analyze every minute. These are the top 2,000 sources globally, so the top 7,000 external links. And we've also got social media sites, up to 800 social media sites here. Of course, with some Twitter content seeking alpha, et cetera. Many of the main providers of social media are included in this feed. It's quite a challenge to differentiate news and social media, by the way. News is significantly different because of its editorial perspective. Social media has there's no limitation to publishing on social media, so anybody can publish on social media, and they can publish anything they want. And so we have to be very careful about spam filtering and other cleaning aspects of social media. There are bot networks, of course, that post on social media that try to drum up interest in stocks for pump and dump schemes. In the news, things tend to be a little less hairy, so to speak, than social media. In news, we have reporters who would be fired if they misrepresented or made fraudulent claims, especially on these premium sites. But in social media, that's not at all the case. So the sources can be quite different. And then the analysis that we do is based on our own proprietary natural language processing. It's essentially lexical analysis. It starts out with a layer of machine learning, and then we dive deeper into details that are based on lexical analysis. And this is some of the details that we dive into through more or less machine learning-based systems, more human-implemented systems. So this happens automatically, and what it does is it creates a simple score vector. So a sentence like Goldman Sachs analysts expect Apple to report expanding margins. This sentence is deconstructed so that this system understands that Apple is the subject, so it looks at part of speech tagging, finds that Apple is the key entity here, that there's an accounting term, which is margins. This is not the distance from ink from the edge of paper. This is, in fact, accounting. And that the margins are expanding, and that's a key relationship. So it finds there are positive accounting expectations, the good accounting news coming out, and that these are in the future. They're tomorrow. So future tense is key because if this was a discussion about last year on Apple, it's not as relevant to traders as if it is happening shortly or in the near future. So the language analytics breaks this down and identifies tenses and complex relationships for finance-specific terms. And then these score vectors, like positive accounting news, are rolled together into indexes. Positive accounting news is rolled together into this fundamental strength index for equities. There's also an earnings forecast index that looks at future tense references to earnings rising or falling. So these are all, these two are representative of what we just saw with Goldman Sachs, but then there's many others. There's general broad sentiments, any positive versus negative references, fear-specific references. Optimism is a future tense subset of sentiment. So we've got a whole variety of detailed sentiments as well as complex topics like innovation. Are people representing this company as being innovative, or are there things like layoffs or litigation occurring? All of these, of course, are known to influence prices. And so we tried to create, we did a literature review for all the macroeconomic factors that are known to predict prices, both on the individual equity level, on the macroeconomic level of countries and fixed income. So we have even things like monetary policy, loose versus tight, interest rates and interest rate forecasts. Then with things like agricultural commodities, materials and energy, safety accidents, and subsidies, sentiments, and weather damage. So all things that are known to impact the prices we are tracking. We roll these up and cover 130 countries, actually 9,000 global companies, 50 stock indexes, and as you can see the rest, many currencies, 30 and 35 commodities. And the history of this data goes back to 1998, so it is quite extensive. It's also highly dimensional in that it covers many emotions and fundamentals, as you saw. And there are separate news and social media feeds, so to prevent the, say, social media pollution of the news, but social media itself has some interesting aspects, especially when it's compared to the news. The coverage, again, is quite broad, from Afghanistan to Zimbabwe on the countries. Global equities include about 4,500 United States-based equities, but really the largest 9,000 globally by market cap. It's also a point in time back to 2006. So we have pretty significant point in time coverage that it updates monthly to make sure we have all the largest companies in the world. And then this is a quick example. The data comes out in big data files that are easy to analyze. I won't go into detail on this, but please do contact me if you want more information about how to analyze this type of data. Here's statistical models that we use on the data. So this data is nonlinear. News flow in general is nonlinear. There will be a burst of fear about Greece, for example. Then it'll fade away for a few months or maybe a year or two. And then there'll be another burst of activity about Greece and fear. So this happens periodically. And that's what's useful to know about this data. Now, some factors can be valuable to analyze in terms of ranking entities. So on the left here, we have a cross-sectional rotation model. What this does is it ranks a given asset class, say in this case equities, by the amount of earnings forecasts, essentially how positive versus negative their earnings forecasts are. In this case, it's a daily rank. So it ranks the top 20 companies in the U.S. news flow by their earnings forecast, and then it buys the top 5. There's a long portfolio of the top 5, shorts the bottom 5, and then rolls it forward day after day after day. So you can see kind of a somewhat smooth equity curve here that without transaction costs theoretically would earn 150 times returns. Obviously, completely unrealistic because it's only one index and it's no transaction costs, but still kind of an interesting relationship. It does show that there is some alpha potentially to be arbitraged with this type of strategy. So that's a ranking model. And then secondarily, I'll be showing you some models based on moving average crossovers. We generally find that sentiment is quite valuable if it's Z-scored or if we look at changes in sentiment. There's definitely some, even on the S&P 500 level, there's some very interesting predictive modeling that can be done when deltas of sentiment are used, especially very specific types of sentiment, as I'll mention. So let's talk about some of the strategies we've identified in this data, because these allow us to time markets to a somewhat impressive extent. Now this is from 1998 to the present, or actually this is through mid-2015. This is the S&P 500. This is a 200-day average of sentiment in the blue line, and a 500-day average of sentiment in the gray line, so very long-term average. I use these long-term averages because it's easy to visually represent it for the entire history of the data. Not because this is the optimal strategy. In fact, this is, I don't know if it's even in the top quartile of the best moving average crossover strategies, but it is interesting and illustrative of how these can work well. So when the short-term news flow becomes negative, when the media becomes negative, then this blue line falls under the gray line. When the short-term news flow becomes more positive, then it tends to blip above the gray line and turns green. And in general, when the short-term news flow turns negative, we see that investors should be selling, but they tend to underreact. And so it creates these lags in selling, and essentially which tracks the business cycle. And in fact, by shorting when the short-term news flow turns negative and buying when it turns more positive than the long-term news, what we see here is a opportunity to ride the trends both up and down. So the long-short strategy outperforms a buy and hold strategy by over threefold and has significantly less volatility and a much better Sharpe ratio. Now, of course, it's wrong sometimes, just like buy and hold is obviously significantly wrong sometimes, but it also tremendously improves the overall returns. As I mentioned, it's over threefold return with significantly less risk. So a very simple relationship, but one that dramatically would improve investment returns over the last 18 years. Oh yeah, just a quick update. It has been negative since beginning of last year, and this was last updated in March, but it still remains negative today. Now, oh, excuse me. Okay, so there's also, we've found some of these in, for example, crude oil that work quite well, and the Japanese yen. Those have also persisted forward. Ever since we've discovered them a couple of years ago, they continue to do well. In fact, the particular crude oil predictor that we've identified has been almost perfectly accurate in the last 2 years since we identified it. So that's been quite amazing to watch. So in terms of our long-only equity strategies, so this is the S&P 500, and what we see here is a strategy where we buy the top 25 stocks, the 5% top price performers on the S&P 500 for the last 12 months. So a given year, take the top 5% of price performers of stocks in the S&P 500, hold them then, buy them and hold them for the next year. And this is the kind of return you'd see. This is a momentum strategy based on price momentum. It's a very simple one, and it's an extreme strategy. It earns about a fourfold return since 1999. We wondered if we could improve this by adding a sentiment index, because there's a challenge with momentum, which is sometimes we don't know if it's for example, a bad stock that was way down and then it's rebounding a little bit. But because it's rebounding from such a low level, then it also is included as a momentum stock. We wanted to see, are the best momentum stocks those that are actually innovative companies that are building something new for the future, that investors are underreacting to how amazing and world-changing this company is likely to be. So it appears that that may actually be true. So what we see here is momentum intersected with an innovation index. So these are the top 5% of the S&P 500 companies, and then taking only those that are also ranked in the top quartile by innovation for the last year. And that comes out to about 10 out of those 25 original companies. And this smaller sub-portfolio dramatically outperforms the others by about 15-fold. So it outperforms not by 15-fold, by about 5 times, but its overall return is about 15-fold since 1999. So that's how we can augment a momentum strategy, and this does expand out to larger subsets. One of the challenges, though, I have to say with sentiment data is it gives you hints and subsets of really good portfolios, but it doesn't give you the entire good portfolio. So if you were to try to find a portfolio based on 100 stocks, that's hard to do with sentiment data. It is possible, actually, with an overreaction strategy that I'll show you next. But with that momentum strategy, it actually did not, excuse me on this, it's unusual. With that momentum strategy, actually didn't do so. Okay, so now here's a quick example of a arbitrage of sentiment. This is an overreaction-based strategy, which means what we do in the last year is we rank the top 100 stocks in the media in the United States by just plain news sentiment. This strategy shorts the quintile, the 20 with the highest news sentiment, the most positive sentiment, and then buys the 20 with the most negative sentiment. So it's a classic contrarian strategy. So before I was showing you underreaction, which is when trends tend to continue. So innovative stocks continue to go up. Stock market continues to follow the media sentiment. But what we see here is actually a reversal type strategy where stocks are very negative in the media and we want to buy them, or they're very positive and we want to short them. So this one does this over an annual holding period. Arbitrage is these quintiles. What we see here since 1999 is about a little over a threefold return to the middle of last year. This is based on news sentiment alone, so it suggests that there's something here. However, what's interesting here is in social media we do not see this pattern. This is only present for news. Number one, this implies that reporters are consistently and systematically wrong in the tone of their articles, which is kind of an interesting thing, but they don't get fired. So they're able to keep working even when they tend to be wrong, probably because they're quoting experts who are wrong. Then secondarily, we also know that social media doesn't show this effect. Social media isn't right necessarily, but it doesn't show this effect. And we see that people in social media may in fact wash out. We've seen this in our own studies of what happens with posters in social media. When they're consistently wrong for a period of time, they leave and they don't come back. Presumably they lose their money, or at least they lose their reputation, and they don't bother talking about markets anymore because it's not worth their time. But that's not true with reporters because they have a salary. So subsets of sentiment. So I showed you a sentiment arbitrage, but we find that there are many subsets, different types of sentiment that can actually be more valuable in terms of their predictive potential. This is looking globally. This is one way of testing the face validity of this data. So I showed you how the sentiment varies over the economic cycle, and that's one way of testing the face validity of data. A second way is to do something like a heat map. And this is a global heat map of an index we call government instability. We're measuring all of the references to unstable governments or instability in political systems versus stability in those systems. And so what we've got here are this heat map from 2014. It pretty much looks like you would expect. Venezuela, this is when Hugo Chavez died of cancer. Middle Eastern troubles, some social protests in the Ukraine. This was before Russia got involved in the Ukraine. This was in 2014. So it generally looks like you would expect back then on that particular year. And then here's an arbitrage across countries. If we take only those countries that have tradable stock indexes, what we do then is we rank those, we take the top 20 countries in the media with tradable stock indexes. So obviously excluding Afghanistan, Iraq, Libya, these countries that can't be traded. These are larger countries, the Nordics, Japan, China, US, Singapore, etc. So these are larger countries. What we do is then we buy the 5 with the highest reported government instability. And this can be countries even like the United States during difficult political transitions. Many democracies are listed here. Japan during political paralysis, Italy, for example. So, and then stable governments are typically those that, the Nordic countries where people almost never talk about government instability, Canada, things like that. So the selection plot is quite interesting, but in general, buying the countries that are said to be unstable gives you quite a significant outperformance over time. So about a 7- or 8-fold outperformance through the middle of 2015. There was a setback recently because of the emerging market issues in early 2015. This has since stabilized, but kind of an interesting phenomenon. So, and it also appears to be buying beta to some extent. During the financial crisis, it did have a downside. We would expect this to be an absolute return strategy, but there is some, obviously, beta being bought here, some volatility. So, but nonetheless, kind of an interesting absolute return model. And that's it. Those are these two, the government instability across countries and the sentiment arbitrage across stocks. These are examples of how we can arbitrage overreaction, both buying negative stocks or negative countries that people have thrown out, that they've excessively discounted, that they're too risk averse about. And then on the other hand, buying those where people, shorting those where people think there is no risk at all. So we're really doing a risk perception arbitrage, buying where people think there is risk and shorting where people think there's not risk. It turns out that that generates a pretty good absolute return. And again, this goes along the lines of what Wilbur Ross said. We buy where others, we buy where the perceived risk exceeds the actual risk. So that's what we're doing. We're buying and shorting extremes of risk perception. Now here's an example where we're only buying where the perceived risk exceeds the actual risk. This is a value strategy. So in this case, we're really only buying it based on earnings to price ratio. So we look at, for the last 12 months, the earnings of a given company, the earnings to price ratio. And then we buy, after that 12 months are over, say in January 1st, we buy those stocks that have the highest earnings to price ratio, so the best value companies. Starting this in 1999, we roll it forward every year. And what we see here is actually a significant outperformance of an extreme value strategy where we buy only the top 5% of the S&P 500, the top 25 stocks, by value. Hold for 1 year, rinse and repeat every year, buying the value stocks. And so a pretty good return here. This is consistent with Ken French's website, where he keeps the various factors for his original Fund and French three-factor model. But then, famous value investors like Warren Buffett say, well, it's not just value that we should think about. We could also think about fear. We buy when others are fearful. We sell when others are greedy. So we decided to take a look at value in the relationship to fear. And what we see is when we intersect value and fear, when we take those top 25% by value and then also intersect it with our fear index, look at only those that score highly on fear, we see a significant outperformance of the value-fear combination. So we've got over a 20-fold return on an annual holding period strategy based on the S&P 500, taking only the extreme stocks that are extremely fearful and extremely value stocks, highest earnings to price ratio. This is the type of thing that maybe an activist investor would buy because they're looking for companies that generate a lot of cash that people don't like or that they're afraid of. So that's pretty much what we're seeing here, that this strategy works very, very well over the many years, buying feared stocks that are also value stocks. So again, about a 20-fold outperformance for an annual strategy with low transaction costs that's holding only S&P 500 companies. The average in the blue line, though, is about 10 stocks. So we're taking the subset. When we expand this out, we still see the value, we still see the fear premium here, even at expanding out to hundreds of stocks in the S&P 500. Even more robust than fear, actually, is anger, which expands out to almost the entire data set. So we rank everything by anger, and we can find even on the top 100 stocks of the S&P 500, combining earnings and anger, we see a good outperformance here. So maybe Warren Buffett should have improved his statement with we buy on anger. We sell on trust. But in fact, anger is better than fear even. So it's not just stock buying. So we've showed you so far underreaction patterns, how we can use, say, moving averages of media sentiment to time markets because people tend to underreact collectively to shifts in the information tone. That's what I showed you with the S&P 500. And then we also looked specifically at certain stocks. So stocks like momentum stocks that are outperforming year after year. Can we improve the momentum returns by adding by taking only a subset that are, say, high in innovation? And that was true. We found that people were tending to underreact to innovative companies that were also momentum stocks, probably not believing that they could keep going up so fast year after year in their stock prices, but they actually did. Then we looked at overreaction patterns, and we showed that there are these arbitrage effects across stocks based on news sentiment itself, quintile arbitrage. Then there's also a opportunity to arbitrage subsets of sentiment, something simple like government instability. I didn't mention trust and management trust. We see a lot of arbitrages around trust and anger and management trust, how people trust company leadership. So, but I did show you the government instability, so there's an opportunity there to arbitrage across countries when governments appear to be unstable. Then we also looked at overreaction based on value strategies. So we find that sentiment data works very well when it's, or I should say much better, when it's conditioned by other types of information, like in this case value strategies, buying high earnings to price companies that also are associated with high fear. So that appears to work even better than a simple value strategy. So again, fear is a marker of overreaction. It means people were afraid of something and they probably became excessively risk averse. So there's a risk premium that we can capture by buying those companies. So sure enough, the fear index does measure the risk premium in that case. Not all the time. When we look at fear, arbitraging it across every stock, we do not see significant, well, we see a little bit of outperformance, but not anything that I would want to trade is very volatile. Fear ranks across every stock is not that useful. But when it's ranked based on earnings to price ratio to identify those that truly were overreacting, then it actually does do very well. So fear itself is interesting because, for example, we see Tesla spikes in fear after a bad earnings announcement, and then the stock, because it's been on a big run upwards, then it starts to roll over and go downwards. So we see that some stocks that were very high performers also can be high on fear as investors begin to become very nervous that the stock might no longer be such a top performer. And then that will generally come to pass. So fear is more of a mean reversion signal, but it doesn't tell you whether it will go up. It's not necessarily a signal that things will go up. It's a signal that things are about to reverse, whichever way they were going. So moving on to currencies. So this is an image of Alexander Hamilton. He established the first federal bond issuance in the United States and was the first Treasury Secretary. And he argued that when the United States was formed, that the individual states who had debt were really confusing the business world, that their individual currencies and debt issuance was impairing business activity. So he said we needed a strong federal issuance of currency with a single debt, and that would assuage the uncertainty across the business world and then, of course, improve both the currency value and business activity. And it turns out he was right. But his words also hold true in uncertainty generally in policy across countries. So when we rank currencies by our uncertainty index in the currencies, and this is references to something like doubts or lack of clarity or literally uncertainties associated with a given currency, when we rank those, we find that we want to buy the currencies that are associated with the highest uncertainty on a given period of time. In this case, this is a weekly arbitrage, and this is a yearly arbitrage. So on the weekly basis, we want to buy, we rank the 8 currencies, the top 8 in the media, and we buy the 2 with the most uncertainty, and we short the 2 with the least uncertainty. So it's an arbitrage of uncertainty, and it certainly seems to take advantage of that. And it's a marker of overreaction. Then on the country level, year after year after year, we also do the same thing, and we find another pretty good arbitrage, not perfect, but of currency uncertainty. We've actually got several other variables that do very well with currencies. In fact, we have many other variables I'm not showing you today, and that are also not in our book that do very well. I don't show them to you if there isn't a good story, a good historical story behind them, because sometimes this data does have spurious findings. We can do overfitting and have correlations that don't hold true in the future. So we only like to really profile findings that are consistent with the historical record, with anecdotes for hundreds of years. That's where we like to profile these. And for example, in that government instability finding, Baron Nathan von Rothschild said in 1812, "We buy to the sound of cannons, we sell to the sound of trumpets," which was essentially a reference to how to buy, relative to war, but also the reality that when a country appears unstable, that's probably a good time to buy. So just to link up the missing piece there. So we do try to look for historical examples. Now here's an example of a Russian ruble overreaction, similar type of uncertainty. This is back in December of 2014 when it was in the media that Russians were buying luxury cars as a store of value. And there was a dramatic spike in buzz. So we can go from, say, 1,000 references a day to the Russian ruble to 40,000 references a day when it's heavily in the news flow. That's the kind of nonlinearity that we tend to see in this data. And in fact, this particular decline in the ruble was not relative to the euro. It was only relative to the US dollar, which had a big rally at this point in 2015. So those are some quick examples. And lastly, I'll talk very briefly about trading. So we have set up trading models on this data. We used to run a hedge fund on this data. And then when we partnered with Thomson Reuters in 2011, we had stopped trading in 2010. So we ran a hedge fund from 2008 through 2010, September 2nd, 2008. And that outperformed the S&P 500 by 24% over that period. But it was very difficult to raise capital during the financial crisis. And those returns are, something like 10% a year. Wasn't that impressive, especially during the financial crisis when there were swings in the S&P 500 of 10% in a given day. So even though we did well and had low volatility, it was difficult to raise capital. And we lost money in 2010, so we didn't have our incentive fee to pay all our software developers. So we had to pivot. So we said, well, look, we'll become a data analytics company. And so we partnered with Thomson Reuters, but nonetheless, we've retained that interest in trading. And with the help of Thomson Reuters, we've built out some, there's a data I've been showing you, which we think is really amazing. We did start trading a small account in February this year using a machine learning-based strategy, a very simple strategy on the S&P 500, not much capital in it, but just out of curiosity, to see if we could get something that would work going forward consistently. One one of our challenges previously trading is that when you're managing other people's money, if you lose money for a year or even a quarter, they doubt that you know what you're doing, and they can pull out the money even if the overall returns are quite high and the volatility is low. So we use machine learning to try to create something very consistent in terms of returns. And we developed this strategy, which is through the end of last month. It's been doing well this month as well. It's up 2% so far this month in May. But in any case, so this is a machine learning-based strategy on the S&P 500 only. We ran it, and then at the beginning of the year we started watching it on paper, and it did really well. So then we decided to put real money on it. It's been trading well since. So this data does have value. This is a simple daily strategy that we're running, but there's other kinds of strategies too, obviously. That strategy that I showed you with the S&P 500, where the moving averages were crossing over each other, that one actually is used by one of our clients. Not the exact same one, but one of our clients was in the media, NN Investment Partners, said that they use that type of strategy, or I should say they indicated they used something along those lines, and they were able to avoid the January correction that I showed you earlier on this year by getting out because of an increase in, for example, the stress index. So they were able to avoid the subsequent sell-off. And so that's the way that this data is used for timing. So NN manages over 150 billion US dollars. So large players are using this data for identifying patterns. And as I showed you, there can be longer-term patterns, such as long-only asset managers are using, and also shorter-term machine learning-based strategies like I just showed you quickly that we developed in-house just out of curiosity. So there are many ways to use this data, and we look forward to hearing your thoughts about it and questions. Also, this book, Trading on Sentiment, just came out a month and a half ago, 2 months ago, and it's really our summary of where the latest research on sentiment has gone. So it's really the latest review of the academic literature, as well as a review, of course, of our data, which is, as we believe, the most comprehensive in the world in terms of its coverage and its ease of use and the number of assets, the granularity, etc. So we look forward to hearing from you if you have any questions, and happy to take questions now in this part of the webinar. Thanks for your time, and good luck with your trading. Look forward to your questions. Let's see here. So one thing, we have a couple of questions here. So have you discovered any difference in the observations between the institutional trader and the retail trader? Excuse me, let me look up here. Having a little trouble in my question window. I can see one line, micro print. Oh yeah, how do we measure fear? That was an early on question. So we're looking at all the, in this case, references, concerns, worries, anxieties, panic, terror, that are associated with a given tradable asset. So if somebody says, I'm concerned about Tim Cook's plan for the strategy of the iPhone 7 rollout, something like that, that's measured as fear because there are concerns expressed. If Tim Cook says, well, I'm apprehensive about competition from Google in the operating system space, then that's also measured as fear. So not just the words, but there are certain expressions that our machine learning models pick up that are identified as having fear-related connotations as well. So it's through text analytics, that's how we measure the fear. And then have we discovered any difference in the observations between institutional and retail traders? Certainly the institutions, especially high-frequency traders, have been trading very short-term patterns based on this type of data. Those have been arbitraged to some extent. And so starting around 2012, we don't see as strong of the short-term news reaction patterns in the markets, meaning short-term meaning the 90-minute to even one-day type of patterns that people used to discover. So the 90-minute to one-day patterns have been arbitraged out to some extent by very short-term traders, especially those that are news reaction patterns. So if you have a single news article that comes out that's very highly positive, that mentions a merger by IBM buying Oracle or something like that, the Oracle stock price will shoot up, but that news release itself is very difficult to game. I mean, now you've got less than a few minutes to trade on that merger announcement, and that's the most obvious example where it's a merger. maybe you've got 10 minutes before that market reaction is over. So you've really got to be, if you're a retail trader, you've got to be watching the news, and it's become pretty much unrealistic for most retail traders. You've got to be, either a professional prop trader or somebody who's running high-frequency algorithms on this. But good question. So, other questions we get sometimes are, what's a realistic way to measure, to actually use this data? How do you integrate it? Oh, so here another question. Where do you see media analytics going next? New innovations or interesting challenges? So in general, what we see is media analytics is actually moving towards image analytics because these images, like I showed you from Greece, can have such a large impact. So quite a few people are working on image analytics, analyzing, airplane crashes, since those are often tweeted, and tweets themselves can be difficult to parse using text analytics. So people are now trying to get a reinforcement of the tweet with images. So if there's a refinery explosion at the Valero refinery in Long Beach, California, and somebody takes a picture of it on their cell phone and they tweet it and they say, fire at the refinery, then text analytics companies now are trying to identify, okay, there's a fire at a refinery, but where are they? Oh, their Twitter tag shows their geolocation as being in Long Beach. Oh, it must be the Valero refinery. So they're getting into even these very detailed types of event analytics. They're quite interesting, but very, very difficult to do. But that's the challenges. So that's what we pursue. Our own particular interest is how do we use deep learning now on this data to extract patterns? Because what we're actually thinking we see with our machine learning models is that there is so much media data out there that we can't all react and understand what it means every day. Our brains are limited, but machine learning is allowing us to look at all of those nuances and very subtly weigh which one is going to influence markets on a given day. And so that's what we're really excited about, is using deep learning to identify where markets are going next, because now that we've got this pipeline of all the information flow that should be moving markets through the media, we can actually combine that with information flow like earnings values and price action. And that in itself, and I think many firms are moving in this way, this big data analytics is very exciting. It allows us to predict on a much greater level than even a retail trader could ever comprehend, or even a human institutional trader. So there was another question here. Do the dark pools get included in the data collection? No, there's no dark pool data. This is all publicly available media. So, for example, chat rooms on Bloomberg, we don't have those. Or private chats, or what if a hedge fund manager texts another hedge fund manager? We don't have that either. This is only publicly available information. So in that sense, it's quite limited. But that is how it works, because it is publicly available, so we're allowed to access it. Yeah, so someone then asked, the trading examples were fitted in sample and then tested subsequently out of sample. What's the ratio of successful out-of-sample strategies to total strategies back-tested? Great question. So we, yeah, these were, the ones I'm showing you are all the ones that, of course, not only fit in sample, but then kept working out of sample. But remarkably, most of them have continued to work. And the reason, so what's the key here is actually the statistical technique that we use to find the strategies. That's the key to what tends to be robust out of sample. So moving average crossover strategies show about 50% of the value that they showed in sample in the out of sample period, maybe 30 to 50% of the value. So if you find a really tight fit on a moving average crossover, well, it's not going to be that tightly fit in real-time trading, but it still gives you about 30 to 50% of what you found, and that's pretty impressive, even that. So that's why I showed you moving average crossovers. They tend to have persistence in the out of sample set as a statistical technique. Then the other kind, the quantile ranking models, those rolling forward with the quantiles, those models tend to be quite good as well in the out-of-sample testing. Not quite as good as moving averages, so I think they might have 30, well, that's not true actually, they have been quite good. They've also got about 30 to 50% performance out of sample. But then other strategies, for example, decision trees, we can fit very tightly with decision trees, but then they just fall apart completely. Neural networks also overfit. Those are nonlinear techniques. Linear techniques like regression really don't find anything interesting in the in-sample set in the first place, because this is nonlinear data. So some people use regression on this. Sometimes they think they find a factor. I don't know. We've never found anything using linear models on this data that I would trust to trade on. So good question. Now let's see, did you find your currencies methodologies effective in the last several years on the background of well-publicized currency wars? That's a good one. In which the markets are driven, if not manipulated, by such large players as governments and their agents, like the IMF. Yeah, good question. What I think our most interesting example was the Japanese yen with the currencies, because our best index predicting the Japanese yen was called price forecast. So the news media forecast of where the yen was likely to go was where the yen was likely to go. So the news media was incredibly accurate, and is incredibly accurate up until the last few months in predicting where the yen is likely to go. And what appeared to be happening was the Japanese central bank may have been leaking their plans to the Japanese media, so that rather than the central bank having to intervene and bet its own money, it could leak its plans, and then the media would publish on it, and the reporters would be hailed as being prescient, and the markets would actually move in that direction. And that did occur. I say in the last few months it didn't occur because recently the Japanese central bank has been trying to get the yen down, but the yen has actually been quite strong. So, and then the other question is, yeah, in general, so broadly, I think what we see are, a good question about the currencies. We don't know who's moving the currency prices, but we do know which factors consistently seem to arbitrage currency values. And I can tell you the price direction itself, where the currencies have been going, at least where it's talked about in the media itself, I should say, creates a momentum effect in currency. So the more the media says that the dollar is going up, the more likely the dollar will go up, for example. So we see a very strong momentum effect. I don't know if that's any governments or agents moving it, but certainly the media does have an effect moving currency prices, and that because that's all that we're really studying is the media. So it's good, interesting question there, currency wars. So deep learning for NLP or predictive models, So the NLP itself, we're also, actually that's not exactly true. So we are looking at deep learning for NLP. The challenge is using the deep learning for NLP, applying it to the right parts. Really the challenge is the human labelers. So we've had human experts label fear when they think that somebody's afraid or an article demonstrates some fear. But we've gotten very low agreement. So we really have to have, this is, for example, CFAs, so humans with who are certified financial analysts. They actually don't really know when an article has fear in it. So then when I get a group of psychologists to look at it, then they do a little bit better job, but they don't understand finance. So it's been very difficult to get people who understand both finance and the particular sentiment or macroeconomic theme that we want to track. And so without human labelers, we can't really do a good job with the deep learning either. So, I mean, we can do, that's not true. We can do a good job, but we can't be perfect. So it's a work in progress. I mean, if humans can't get it, the machines can't get it. So that's something we've been working on. But deep learning, we've been not applying it yet, but we're definitely looking at that too. So, but when I was talking about deep learning, I meant on the predictive model level. Again, deep learning could be a way to overfit, but what deep learning does that could be very exciting on the predictive models is it allows us to look at the overall tone. Right now, in our machine learning models, we've already got Bayesian classifiers that tell us if something is a business article or a sports-related article or an entertainment article. So we've got the filtering on that level, but deep learning should be able to do that all in one network. And that would be interesting, but we've already got that sort of a deep learning approximation that we're using by multiple layers of classifiers. But in the level of the predictive models, that's always been difficult. The way people have tried to created deep learning without realizing it is essentially regime shifting. So that's one way that it can be done. But so regime-dependent models is one way of sort of approximating deep learning. So in addition to news and social media, what other kinds of alternative data feeds would you find useful to describe or predict financial dynamics? Google Trends is a very popular one. That's a good question. So Google Trends we've seen, so obviously quite a few companies now producing other alternative analytics like Yelp reviews. I think online reviews are probably a good one. Glassdoor reviews, Yelp reviews. Those are also, I think, very good alternative feeds that I'm familiar with. And is spam an issue for social? Yeah, definitely. Spam is a big issue for social media sources. We've got our own spam filters. We've got better spam filters than the major providers themselves have. So Yahoo Finance sends a lot of spam our way, so we have to filter it. Twitter has a huge amount of spam. Twitter has almost no spam filter. We see actually organized criminal rings of people organizing bots that will befriend humans, so robots that will put out benign statements like "great call" or "very interesting idea." They'll make these statements to humans, direct messages, and the humans will friend them. And they'll send, a benign statement every few weeks, become their friend, and after 12 months in a simultaneous attack, 100 of these bots will suddenly recommend to their new, human friends that they should check out, XLZY, which is some, stock that they're all buying as a penny stock that they've already accumulated, and they'll say, wow, XLZY is up 5%, I wonder what's going on. And then the next day, because of all the human buying, they'll say, wow, XLZY is up 15%, looks like something's moving. And then all their human friends will start telling their friends, and pretty soon there'll be a big pump and dump scene going on. Very sophisticated, though, and initiated by bots. So we've seen them all. The reason we've detected them is they'll post often the same message simultaneously. It's very interesting. So it's this question. So, oh, long question. Sorry, I have this tiny little window for questions. Okay, so spam is an issue. Okay, the holding time for your test portfolios is 1 year. The market environment since the financial crisis does not lend itself to holding securities for such a long time because of regime shifts more frequently and so the market sentiments. We see this in zero interest rate environments, in the constant struggle, whether the rates are going to be raised and when. So what is the effectiveness of your strategies for shorter time frames than swing strategies? Oh, good question. So I didn't show, actually the sentiment tends to work better on weekly and monthly periods. So I showed you these long strategies because those tend to be more accessible to everyone, even in personal portfolios. But yeah, over weekly periods, we see very, very impressive strategies. Actually, daily are the most impressive. Daily, weekly, and then monthly are also very impressive. So a quick example of a monthly strategy is when there's a leadership scandal at a company. So we have an index called management trust. So when management trust plummets because of some criminal indictment or LIBOR fixing at Barclays or a whole variety, some CEO has an affair with an employee or something like that. Usually the stock price falls a lot, and then about a month after that scandal breaks, you can pretty much safely buy that stock. Not all the time, of course, but sometimes, on average, you can safely buy that stock, and then within another month it will have rebounded. So the monthly patterns can be quite interesting there. And then over the weekly period, we see other effects, usually fundamental type effects over the weekly period. Social media, we see a lot of weekly reversals. So when people are very excited in social media about given stocks, they of course tend to fall the following week. And when they're very depressed or very angry about a given stock, it tends to rise the following week. So in social media, we see a lot of weekly reversals. In news media, we see monthly bounces based on very negative news that comes out, typically about management teams. That's a very good one. Great. Well, I appreciate all your questions. Looks like we're a little over time. So thanks, everybody. And it looks like that's it for now in terms of questions. I don't see any others. All right. Well, this will be the end of the webinar. Again, the book is Trading on Sentiment. So if you'd like to read more about it, please check out the book. And I look forward to your thoughts. Feel free to follow up via email if you have any other specific questions or thoughts. All right. Take care, everyone. Good luck with your trading. Take care. Bye-bye.